Welcome to the investment panel. Investments are important in the financial well-being and planning of dental professionals. They provide a means to secure their financial future, achieve various life goals, and mitigate financial risks. This panel will be focused on strategies and best practices when it comes to investments. The panel is moderated by Austin Hare, lead podcaster for the Helping Healthcare Scale podcast. He's a managing partner at Leaders Real Estate, a two-time American Ninja Warrior contestant, and real estate investor. Austin helps dental professionals find the right space for their practice, as well as find the right buyer for their dental real estate when they're ready to transition out. Joining him on stage as panelists are Dr. Johnny Witanachi, a practicing endodontist, founder of the Passive Investing for Dentists Facebook group, founder of the Walk of Wealth platform, which helped dental professionals achieve true financial independence through passive investing, and he is an experienced and avid real estate investor. Dr. Simon Balin, he is also an endodontist by trade, but also the founder of Balin Builders, a renowned construction company in New England. His success with Balin Builders has propelled him to the creation of Balin Development, a development company that oversees projects exceeding over $250 million in commercial and multifamily real estate. And last but not least, we have Mark Jackson, the founder of Investor Comps and Atlanta Home Deals. With his two companies, MJ not only serves others through education, but also with passive investing opportunities through real estate. He is a real estate valuation coach and entrepreneur, and he is the go-to expert for investors seeking transformative success. With a passion for faith, family, golf, and real estate, he shares his dynamic message nationally and internationally. Let's give a round of applause for the investment panel.
Woo! Dental Podfest.
Here we go.
All right, well, yeah, great. Thanks everybody for showing up early in the morning. And so just want to kick off the panel and talk about 2024 and the future of real estate specifically and investing. And curious what you guys are seeing and what you guys are looking out for.
I'll go first. Blessings and joy. It's quite an honor to have the opportunity to care and share with each and every one of you. This is a really unique and dynamic time in real estate, in particular, whether it's multifamily, if you're doing out-of-ground self-storage, or single-family real estate. And in my niche, where we're really focused on one-off assets, the dynamics of what's happening with the Fed, holding interest rates, this being an election year, and what happens historically there, where typically rates will go down. You'll see an influx, especially coming in this spring, with buyers returning to the marketplace. But there's always going to be those that are displaced in the marketplace. And that's really where the biggest opportunity lies. So we like to use Warren Buffett's phrasing, hard times call for hard assets. And without a doubt, as compared to being in the stock market or anything else, engaging in one-off single-family opportunities is a great and dynamic space when it comes to real estate right now, and being in a safe, secure place for deploying capital, whether the markets are up, down, whether there's contraction in terms of just basic supply and demand in the marketplace, is going to allow great opportunity for success.
Well said. Thanks. So to piggyback on what he said, I think this is 2008 happening all over again. So this is an incredibly exciting time to be a real estate investor. I focus on stuff that's passive investing, which is really, in my opinion, what dentists should focus on investing in, because it's a way to invest in real estate and get all the advantages of real estate without actually having to operate it. Having said that, I focus on assets like large multifamily real estate, and because of this interest rate and capital market flux, there's a lot of distress with operators. So what's happening is mortgage rates, people went in at 3% with floating rate debt, and stuff is readjusting now to 7 and 8%, and people's mortgages are doubling and tripling. All of a sudden, these operators can't stay in the game anymore, and they're forced to sell at very great basis. So we're able to go in and kind of invest in great deals, probably some of the best deals you're going to see in a decade, like last 10, 15 years. So I think 2024 is like, if you haven't gotten in, this is a great time to start. I don't know what you think, Simon.
I'm going to piggyback further on what both said. I think it's a great time to invest. I don't think it's 2008 as bad for single family or for housing, but for office is getting hammered. Commercial's getting hammered.
Yeah.
2022, 2023, I couldn't get a civil engineer to call me back. Today, they're calling me on a daily basis. So what we're seeing in terms of costs, they're coming back down to reality. I'm a ground up developer, so we build from the ground up. We're ground up investors as well. So the value of what we're getting out of our subs, the value that we're getting from land that we could acquire compared to what we were acquiring a year or two ago is vastly different. So even though rates have gone up, the deals are still penciling, and they're penciling even better. And we know that we're going to be refinancing once we're fully occupied. We have ways to get into longer term debt at lower rates once we're fully occupied. So our numbers still pencil very, very well. I would say even better than they did 2 or 3 years ago. So I'm bullish on 2024. We're even doing build to sell products, which we weren't doing before. I just see the rates coming down right before elections. I'm not going to get political with that, but they will. And that makes our build to sell products pre-selling before we ever put a shovel in the ground. So it's vastly different than what we had 2 years ago.
Yeah, thanks guys. And I think it's funny, we got 2 dentists up here. I'm not a dentist and I'm the only one buying dental real estate. But in terms of 2024, I try not to think in terms of yes or no, but just probabilities. And so, I'm trying to weigh the fact of we have an election year, which brings interest rates down historically, but we also have a lot of debt and a high deficit, which causes inflation, which brings interest rates up. And so that's a question that I'm going to ask to you guys as well. But we invest in healthcare-backed real estate, specifically a lot of dental, but also urgent care and vet, dermatology, behavioral health, etc. Anything sub 10,000 square feet. And, it's been a really interesting past couple of years. In general, healthcare has been recession-resistant, inflation-resistant, pandemic-resistant, and it's been a really, really good asset class. And so as a result, you have not seen a lot of distress, and it's made deals historically hard to come by. So, you're in a situation where in healthcare real estate, your interest rates were higher than your rates of return that you're getting from some of these practices or some of these sales. And so it was interesting that people were buying essentially underwater using negative leverage. And so, the thought is it was historically just so not distressed that people didn't have to really worry about dropping their prices. So if you had your price, you would just say, well, hey, I got my price. Like, I'm renting out this building. The operator, the dentist, is continuing to pay me rent. I'm not distressed, so if I can't get my price, I'll just hold, right? So that's not really a condition for lowering prices. That being said, I think that people who have had a desire to sell have been holding for so long now that it's kind of starting to weigh in on them. And so I think that when we get into 2024, we're going to see people start to kind of slowly adapt to the climbing interest rates. And so I think prices will slowly start to drop a little bit, or at least stay the same. And I think we're also going to start and see interest rates come down. And so it's been interesting because I'm not sure how experienced everybody is here in real estate. But in general, when interest rates go up, real estate prices go down because most everybody uses mortgages and leverage. And so the more expensive that capital is, the less cash flow you have to operate that asset unless they drop the price. We haven't seen a whole lot of that surprisingly this year, and that's asset dependent. So there has been a little, office has gotten really crushed. Multifamily is going through a lot of distress right now. And so it really just depends on the asset class. And so, what we're trying to weigh is when is a good time to get in, because you don't want to catch a falling knife. I think 2024 is a good time to get in. I do think that interest rates are going to drop, but eventually the debt that we have is going to catch up because we're going to have to print more money, from a Federal Reserve standpoint in order to service this debt. And that's ultimately going to drive inflation and drive interest rates back up. And so what we're kind of predicting is an interest rate that's going to kind of start to drop towards the end of the year, the election, and then might start to pick back up again. And so if that is the case, that would mean that you want to start to get more aggressive in the assets that you buy this year. And I'm curious what your guys' outlook is on that.
Yeah, I really think that that's a key element. It's interesting to talk about the panel because I'm not a dentist either, although my claim to fame is my daughter is a dentist. So I really resonate with this group. But overwhelmingly, when you talk about really the forecasting, my background is as a real estate appraiser. And so it's utilizing those skills to see not just what's happening in the market today, but projecting into 2025, 2026, and looking at what tertiary markets are going to perform the best. When you're talking about engaging and deploying your capital stack differently, whether it's going to be in multifamily, whether it's going to be in commercial space, whether it's going to be in out-of-ground self-storage, that type of thing. When we look at how rates are trending today, the amount of buyers that are in the marketplace, but the contraction of available real estate for folks to actually be able to buy, that's the dynamics that's keeping prices high, even while rates were high and then are slowly coming back down. Certainly this is that season, the springtime, where there's going to be a lot of activity as well, but overwhelmingly, how does that translate to spring of 2025, after the election over and the Fed has to start making some moves? Those are things that we keep a really close eye on intentionally and for good success, because the four dynamics that we look at in terms of population growth, job growth, rental growth, and is it a market area that has landlord-friendly laws so that you can actually transition in and out of a client if you need to take an asset back, are the ones that are really going to drive good success after we get into 2025.
The question was about interest rates. Is this on? Thanks. I don't like to try to predict the future. I can't. Not very good at it. Most people aren't very good at predicting what the Feds are going to do. The Feds can say one thing and do another. So the best thing to do with real estate is, when interest rates are fluctuating, is lock in, right? So if deals can pencil, it doesn't matter what the interest rate is. Interest rate is just a number. It just matters as whether the income from the real estate can support the debt service. So in terms of that, if you're locked in and fixed rate debt long term, I mean, I wouldn't even do fixed rate long term right now. I think interest rates are going to go down and to the right over the long period of time. So based on that, this is the time to maybe do more bridge financing because you can refinance and stuff into permanent products later, like Simon was talking about. So interest rates, again, like American real estate in general, the values are kind of BS because it's all based on interest rates. It's completely based on the cost of capital. And the values of real estate go up and down based on how cheap or expensive the money is. So it really comes down to a cash flow game. And that's what dentists, investors can bank on, because cash flow is worth more than net worth, in my opinion. Because cash flow is what's going to pay the bills when you get injured, when you get sick. And so if you're buying real estate that can give you income, that it's independent of you working, of you doing anything, and you can make sure that you have a source of income coming in, maybe multiple sources of income from real estate coming in, that's how you decrease the dependency on dentistry. That's how you increase the freedom in your life. And so the interest rate is just one of the factors that gets manipulated. But if you understand interest rates, you understand capital markets, you understand getting into good debt products for your real estate, it's not an issue. It's a non-issue, in my opinion. What do you think, Zach?
So as a ground-up developer, we're looking at interest rates from the time that we purchase land to the time that we start building something. It could be a year to 2 years. And we don't start closing our loans until we have permits in place. So it's very important for us. We're speculating coming in what the interest rates are going to be in a year when we start actually going vertical. So for us, it's very important to have multiple points of exit and multiple very profitable points of exit. So I can take a piece of land, get all the entitlements, speculate what the interest rates are going to be. But once I have my entitlements, I have a point of exit. Whether the interest rates are high, interest rates are low, will a builder buy this piece of property? So I could sell to a builder once it's entitled. I could sell to an operator once it's built, or I could long-term hold. So everything that we're actually building, my intent was always long-term hold, but interest rates do have an effect on that. We're seeing some of our projects now that we're at the point where permits are in place and we're getting multiples to sell because you have speculative builders who want that product. It's springtime, they want to build it, and they're offering us a lot more than what I think it's worth, so I'll sell it entitled. So yeah, absolutely, interest rates have an effect on what we're doing on a day-to-day basis. In terms of when we do start our vertical construction, I'm always looking for a very long-term loan. So I won't touch anything in terms of floating debt that's anything less than 5 to 7 years. For us in the development space, that's a decent amount of time. And if we're locked into 5 to 7 years, I know in 5 to 7 years there's going to be movement. And if it pencils at the rates that I have locked in for 5 to 7 years, plus that also includes our construction period. So we have another year to 2 years. So I look at 7 to 9 years in reality. So the float on my interest doesn't affect me there. But again, looking for multiple points of exit.
Yeah, I think that's a good point you made about, your strategy was to hold it definitely, but it's always for sale at the right price. And so, we learned that the hard way. We developed a property out in Lee Summit. It was a multi-unit physical therapist and a Starbucks, and our mentality going into it was, hey, we're holders, like we buy and hold forever. And so we went through one of the most lowest cap rate, highest selling, most bullish periods of the market ever back in 21. We got multiple calls, multiple offers to buy it, but we stood by our principles. And so in hindsight, the lesson was, look, if somebody's going to offer you over market value for your building or your asset, you should sell that. And so it was a lesson in, you don't always have to stand by your thesis when that's proving to be wrong, and just being more flexible. And so, but anyways, I would like to know, if everybody could just kind of briefly share your story, maybe less than a minute, kind of how you got into real estate, and then what kind of deals you're doing specifically, and maybe just we can get kind of high level, because I'm not sure how experienced of an investor everybody is, but just in terms of what kind of deals are you buying, how are you structuring those deals, and what kind of returns can investors get?
Go ahead, Simon.
So I was somewhat forced into this. I grew up around construction. I went to dental school, became an endodontist, and then we started building our practices. My wife's also a dentist. She's a pediatric dentist. We're on the East Coast and hired a contractor who came highly recommended by all the big suppliers, and it was an absolute nightmare. So going through the second office construction, we hired a different contractor, and the first thing they did was cut through the Verizon Fios phone lines of pediatrician practice, 8 pediatricians in one practice, and as a pediatric dentist, that was our bread and butter. We're on the beach in Puerto Rico, and we get the phone call, your crew just cut through our phone lines. This was 2015, so Fios took 6 weeks to come out and fix their phone lines. Yeah. So I'm not dealing with stress anymore. So I got my contractor's license and started building dental offices. The intent was just to build ours. We were creating our little DSO. But then the architects started referring us clients, and just that kind of snowballed, and we started building a lot of dental offices. I always knew I wanted to get into multifamily, and dentistry would be a stepping stone into that. And I always thought I was going to do what Johnny does, buy existing assets. My father had plenty of friends who were in that space. But in the New England area, a building that's 15 years old already requires a decent amount of maintenance. So anything that we're looking at that was decently priced was built in the 1800s. I didn't want anything that was old. I didn't want maintenance. So I said, you know what? I'm just going to take this a different way. Let's do it ground up. And we started ground up construction. So we currently have, I think Glenn said it's about $250 million in the pipeline. I've got 3 LOIs out. It'll be closer to $400 million by the end of the month. But everything's ground up, and that's what we're doing now. Very little in the commercial space. I do have some commercial buildings that came with land that we purchased. It's not my bread and butter. I know that's more your bread and butter. Just not an asset class I'm super comfortable with, but multifamily, ground up, that's our game.
So for me, I'm an endodontist also. For some reason, endodontist like real estate, I guess. But so I started, my journey was a little different. I'm from a very poor immigrant family. So my father gave me a book, was Creating Wealth by Robert Allen, while I was in my second last year of dental school. And after I read that book, I'm like, wow, this is real estate. This is the way I'm going to go and make a name and build wealth for myself. And I was really sprung by that, seeing, how much, what real estate could do if you were to go and execute. So I started with active in real estate investing. I just wanted to get investing in something. I bought a single family house. I was just I was making money as a dentist, stacking it, and just trying to throw it into I wanted to get into any deal. And I was just buying deal and randomly, I didn't have any strategy. I didn't have any mentors, podcasts and Podfest, Audible, all that stuff. None of that stuff existed back then, right? So I was just kind of trying to figure it out on my own. I was new to the country. I didn't know anybody here. And so I made some good deals, made some bad deals. But I kept buying real estate and holding. I eventually built a multi-million-dollar real estate actively managed portfolio, but at that time I was also working 45 hours a week as an endodontist, 10 properties. Now I have 2 young children, and it's like there's no more bandwidth to do anything, and I'm not doing well at any of these things, right? I'm just mediocre at being a spouse, a parent, a real estate operator, and a dentist. So it's like, all right, I've reached a bandwidth. This is not. So that led me to discover the world of passive investing. Once I learned about passive investing, I sold all my active real estate, and I think I only have like maybe 2 or 3 properties left that are actively managed, and the rest I rolled everything into passive investing, and I didn't look back since, because now the income that you build, right, it gives you, like I was talking about earlier, the income is what gives you freedom. If you don't have income, you don't have freedom, because you have to go and make an income to pay your bills, right? So once I learned that, hey, look, you can build income and you don't have to be responsible. I can defer to third-party expertise to handle the day-to-day, right? Dealing with tenants, toilets, termites, and your time. Those are the 4 T's. And I said, listen, I'm taking all of that back by investing passively. So since then, we went all in, and I'm like, listen, all dentists need to invest in this stuff, because you can get tax benefits, you can get, like we talked about, the income, you can have a predictable path to building wealth. I'm like, everybody needs to know this. I became an evangelist for passive investing for dentists, right? That's why I launched Walk of Wealth, which is a company based on, the mission is to help 1,000 dentists achieve financial freedom through passive investment. So that's why I'm like, hey, look, I'm here at this event. I need everybody, all of our industry to know this. Like 401k plan, the stock market, financial advisor, all that stuff they tell you is, in my opinion, is garbage, right? So this is a new thing to learn, and I wanted to make this education platform so everybody could get it, right? So now we've helped over 100 dentists start their path to financial freedom and investing and developing streams of income. And we've done about $301 million worth of real estate transactions over the last 5 years. So we've been very busy and looking to expand and help more people.
So you should have known me.
I do now.
Just like Glenn, the whole dynamic is that you would have never had to even get your hands dirty in real estate. You could have been passive from the very start.
Yes.
And that's what Glenn's been able to do. We met about 6 years ago. My background is a real estate appraiser. I've done a wealth of investing in the single family space with that level of expertise, knowing and being engaged so you can make a profit on the buy and really create that margin space in the event that anything shifts and adjusts in the market area. Plus, I'm able to port that information because we've operated in as many as 21 states as well as the territory of Puerto Rico. And no doc has actually gone to the properties that they've invested in. They haven't been in a situation where they've had to, get their hands dirty in the real estate, that type of thing. And it's been a joy to utilize the God-given skills that I have to help, especially in this space, these dentists that really care about their patients. You want to be in a situation where you can look after your practice, but have that extra passive wealth growing in the background without having to have the knowledge other than looking at a deal, knowing what your rates of return are going to be, watching that capital come back, and then putting it back to work together. Putting back to work again. I mean, the last week and a half, Glenn, I've done 3 more deals together on capital that he had sitting around. And so it's been my joy to take this skill of being an appraiser, rolling it into operations that allow us to focus and help practice professionals avoid that trap of lazy Montana. We should have met a long time ago.
Yeah. Move forward from now. The 2024 is a big year.
Yeah, thanks guys. Yeah, my approach is actually split prong right now. I'm investing a lot of time in short-term rentals that are luxury, that you can do weddings and events and that sort of thing, and that's very profitable. And then I'm also spending a lot of time on the healthcare-backed real estate. And so you saw that I was American Ninja Warrior on the thing. Health and fitness has always been a big thing for me. So how I got into this whole thing was I had some gyms in Orlando, and I was growing them by what you would call de novo. And so I went and I had an idea, like I wanted to go to Winter Park, that's like the cool, sexy area, and I wanted to stay away from Kissimmee because those demographics are garbage. And that's when I started working with my partner, and he was doing the site selection component for me. And we ran an analysis that was like a lot more in depth than any broker I'd ever worked with. And we found out, hey, actually, the demographics in Winter Park are like really saturated, rents are really high, competition is super stacked, and Kissimmee is wide open. And I just had no idea because I realized you can't make good decisions without good data. And so that's when he invited me to come start working with him full time. I actually I sold the gyms in 2019, right before COVID, dodged that bullet. And then he invited me to come work with him on the site selection and the real estate investment part. And so what had been happening with him was he'd been doing urgent care site selection for 14 years now, and just realizing, hey, I'm bringing all the value to these landlords. These are hospital-backed urgent cares. They have national credit tenant, which means when they sign a lease, the value of the building goes way up. He's like, I'm getting my commission, great, but I'm not really participating in the upside. It's like, how can we take advantage of this? And so essentially that's when we started working together, is like, hey, why don't we start to buy this real estate that we're doing all the site selection for so we can participate in the upside? And so, when a large credit firm like apparently DSO is a controversial word, but at the end of the day, they do have great credit, and they're what's going to drive the maximum value to the building. And so what we do is we try and buy buildings that are going to be backed by DSOs. They're already backed by DSOs, or they're going to be backed by DSOs. And so sometimes you can find arbitrage in that market when you can find a deal that's not quite penciling for the value that it should be. So easy, right? Like everybody just go out and buy, find deals well, have relationships well. I thought so too. It's taken me 4 years and over 180 podcast interviews with different executives to be able to find deal flow. Because at the end of the day, it is a lot harder than I thought to get the trust of a lot of these $100 million organizations to hand you their real estate. And so essentially that's what we do now is we're looking for these deals where we can buy the real estate that's going to be backed by a good credit tenant. Probably 75% of what we do is dental, but then there's also other spaces as well. And so really when you get creative with the financing, you can do some refinances because you buy it for a certain amount. When it's worth a higher amount, you can actually refinance that and return a lot of the capital to the investors. And so we can get, 16 to 20% annual returns on to our investors, and very much passive, like they're talking about up here. So that's my story, and those are the two kind of things that we're working at. And so I would like to ask you guys, maybe just give a little bit more context around your particular asset, because I think we're all kind of in different real estate niches. And so I think from the outside, you just say real estate. Like, I can't tell you how many times, somebody just says real estate and they assume like it's all the same thing. But I mean, residential is so different from commercial. And then commercial, you can still subdivide that up. You can have multifamily, you can have office space, you can have self-storage, you can have retail, you can have, there's a lot of different classes, and they don't necessarily all affect each other. I mean, office space has been getting crushed. Retail has been doing awesome. So I would just like to take this time for each person to kind of identify your particular asset and then make the case for why you think it's a good time to get into that asset.
Yeah, so I operate entirely in this single-family and small multifamily space. Give a really good example, especially when you talk about deploying capital, utilizing your capital stack. We just closed out on an asset in Gary, Indiana. It was a quadruplex. We acquired it in spring of 2019 for $134,000. It's already performing 3 of the 4 units. We finished the 4th unit out. It just sold this week for $210,000. The 2 docs got in on that deal, so it was 120-some thousand. Each guy took, 50-some thousand of it, that type of thing. They wound up getting back $78,000, plus they earned monthly interest returned every month from 2019 going forward. So, hey, Alyssa, how are you? Anissa, excuse me. And so those are the dynamics that we engage in. We do those in different market areas very strategically. Again, looking at those tertiary markets that are going to allow for good returns. It allows me to deploy my skill as a real estate appraiser, making sure I'm able to analyze those very effectively for the docs. We give a nice perspective, look at a project summary. This is the project. This is what it's going to earn. These are your projected returns, no promises, but allowing them to see how we perform, not just now, but also historically, and what we look for going forward in terms of future value. So really stick in that space. Puerto Rico's been absolutely phenomenal for us. Lots of duplexes, triplexes, quadruplexes. We just finished up leasing up a 9-plex there. And so those returns typically are going to have a nice carry cost, about 8%, but an equity share on the back end that gets those returns in the double-digit space consistently, pretty predictably. And that's my niche. I stick with it. I think funds and syndications, I invest in funds and syndications myself, but I really like to be in a situation where anybody, you're in that space that you can definitively engage in, answer all questions, remove some of the skepticism that's in place. But the other thing that's really nice is being engaged primarily with Dennis, because you talk, you share stories with each other. And that way I can say, hey, look, Glenn, talk to Paul. Hey, talk to Rob and Gertrude that are in California, talk to Guy. And you're able to have those conversations not only about your own practices and maybe some other conversations, but the reliability of what we've done as a track record for good success. So that's our space. We love it, and I'm not going to move from that anytime soon.
Cool. Yeah, I focus on large multifamily real estate. I look for the stuff that's the lowest risk, right? So lowest risk. All commercial real estate, multifamily real estate makes up about 80% of it, and it's by far the lowest volatile, lowest volatility, most predictability of outcome, most predictability of cash flow. That's why I think dentists should have majority of income or investing dollars in low-risk cash flowing assets. The reason that multifamily real estate, if you think about it, most of us here have either lived in an apartment building, live in a neighborhood where we see an apartment building, or maybe we know somebody, and that apartment building's been there for 30, 40 years. And that means the people that own that building, there's been people paying rent for 30 to 40 years, right? They've been paying rent. Income has been predictable for all this time. The owners of these buildings have lived off this income, have been growing their wealth. Now, with the large multifamily real estate, you also have the ability to have third-party property management, right? You have the ability to have professional companies that focus only on multifamily real estate, so the dentist doesn't have to, right? We now can really be rest assured that somebody way better than we could ever do it is taking care of it, and we still get to get the income and the wealth, right? So that's why I focus on the large multifamily. People always need a place to live, lay their heads. It's a recession-resilient, recession-proof in place, right? There's historical precedent for that. 2008, we saw the great financial recession. We saw massive short sales, foreclosures. All these people lost their homes, right? Everybody was wiped out. But where did those people go and live? The people that left and were kicked out of their homes, they went and lived in apartment buildings. So what happens is during downtimes, apartment buildings do even better. 2020, we had another mini recession, the man-made factors due to a pandemic. And what happened was retail, industrial, commercial, office, everybody stopped. Everything stopped. But guess who didn't? Everyone paid their rent. We still collected 90% rents, even during a global pandemic. So what that means is that people are always going to pay for a place to pay their head. It's Maslow's hierarchy. You need food, water, shelter. Right?
Yes, sorry to interrupt you, but I just want to give you the chance before we run out of time here, so go ahead.
Okay, so I'm in a very similar space. So we're not, we have 30-unit properties, we have 200-unit properties. So the multifamily space is our niche, but from a different aspect, we're ground-up developers for the same exact reasons that Johnny's mentioning. We're looking for our properties to do what we call infinite returns. I think Johnny discusses this as well. So we build when rates are where we want them. We refinance out. All investors get their capital back, at least their capital back, and then they stay in the deal. So at that point, it's infinite returns. If you have your money back, but you're still getting income afterwards, you're not worried about the initial capital that you put in. And the thought process is hopefully you rinse and repeat and you come with us to the next development. I stay out of most other types of commercial, even though multifamily is considered commercial. I stay out of other types of commercial because we saw what happened with the pandemic. At least for the dental space, we can't work from home. So the properties I do own in that commercial space are medical or dental, and they are occupied, most of them by businesses that I own. But large office, I'm not interested in that at all. So multifamily, for the very reasons that Johnny mentioned, everybody needs a place to rest their head. I'm not in anything smaller than 5 doors because 5 doors and up is considered a commercial property. Below that, it's still under residential. I want 30 doors or more for all of our properties. We do own our own management company, so it's easier if you're sending a technician out to fix something. If you have 50 of the exact same thing, you could have stockpiles of parts in the basement of that building. So your maintenance is much easier. I don't work with any of my tenants. They don't know my name, hopefully. I don't collect rent. I don't deal with the T's that Johnny was mentioning. I don't want that headache. I've kind of got out of endo because I wanted less stress, not more stress. So that's why multifamily space works very well for us, and we're sticking to it.
Great. How are we doing on time over there? Cool. All right, great. Well, yeah, thanks, guys. Appreciate your time.
Thanks for everybody. Appreciate it.
Thank you.